This is Professor Milligan, and let's discuss what a breakout actually is. So we're talking about a breakout in terms of price and volume. I use the price and volume to determine a breakout, and usually the breakout is my entry point. In other words, I use a breakout to determine when I'm going to enter a position. I'm going to buy. As I said a number of times, I'm a very patient investor. I'm looking for certain key things, and I'm willing to sit and wait when I find them. The reason being is because when I do find them, the returns have been substantial and they're well worth the wait. AYX right here. AYX is the company. Not so much concerned with the company. In fact, this is an old chart from back in 2018. But the reason why I brought it out was I wanted to highlight a couple of things. First and foremost, what you're seeing here is a old chart from 2018 on AYX. The reason why I bring this out is I wanted to show you a couple of things here. So let me put a little color on here for you. So what you're seeing right here, and the reason why I'm showing this is these are all earnings. All right, so this was earnings that were reported. But here's what I want you to notice. This green line right here is the volume. And you can see that the blue line shows the average daily volume over, I think I went back 20 days. So the last 20 days is basically a month. So I went over the last month and showed the average daily volume. And you'll see right here that average daily volume looks like it's doubled, almost tripled. And the price went from $30 a share. It looks like it popped and ran as high as $38 a share right here. Looking at another company here, looking at Grubhub. I'm not sure what year this is. Let's see what, not sure what year this is. It's not recent though. I didn't read any recent charts. So you're looking at Grubhub. Again, this should move a little faster, but I'll circle some things and show you again. You can see right here. Now you've had a tremendous increase in volume here. And then here's another one. Look at this one. Here's your increase in price. At the same time, your increase in volume. It just so happened that this corporate event of earnings is one that's going to actually drive up volume. And look at that. So stock traded sideways, ahead of the number comes out, stock opens up, looks like it goes from what, 46, 47 to 52, 53, then goes as high as looks like 56, 57, trades sideways a little bit. And you can see here again, here's another breakout. Price and volume, price and volume. And then look at this run from here, price and volume. And the thing looks like it goes from about 56, 57, 58, looks like up into the 70s range over the next basically 2-3 months. So been 55 to 70, which is nothing more than a 15-point move. But on margin, that's a 30-point move on a $50 stock. So once again, well over 50% move in 3 months. Let's look at another one, Kroger. So looking at Kroger, once again, I'll put a little color on here so you guys can see it. And you'll see it again right here. So there's your volume. And look at this gap from 26, looks like, to 28, then runs all the way up to 30. That's your gap. Some backing and filling, which again, I talked about as the Fibonacci's. So you can see this thing ran from basically 26 to 30. The fib to be a 2-point, half of that move would be a retracement. So from 26 to 30 is 4 points. Half of that would be 2 points. You can see right here, we retraced to the $28 mark. And again, then you see your run. Now in this one, again, earnings. But look at this. In this case, not sure what happened, but again, the assumption here is that the earnings probably missed what Wall Street was expecting. The stock closed at 32, 30, 31, and then gapped down and opened up, it looks like, at about 29 and trade as low as 28 and change. So what you have here is, in this case, they missed the earnings. So this was not a breakout. This was a short-term breakdown. The last one we're going to look at is NVIDIA. Let's put some color on here so you guys can see it. Make sure you see it. And again, volume and price, they overlap here, but again, you can see volume and price. Here you see it again, volume and price. Here you can see it again, volume and price. If you happen to miss this stock, and I'm not sure what year this is from, but the stock went on a major run. You can see the stock went from, what is this, basically $40 a share. So let's say on the first breakout you got in here, it looks like about maybe $40 a share. And you can see over from May till about, looks like probably December, stock ran from $40 a share, went all the way as high as 120. So again, that's a 300% increase in price. And as you can see along the way, the stock confirmed everything along the way in terms of what's going on with the price and earnings. So there's the price. This is a breakout. This is what you're looking at. All right. So that's what breakouts look like. That's what we look for. And that's what's going on here. Price earnings ratio, also known as PE ratio. Let's take a look at this. You're looking at JCPenney. Now, the reason why I chose JCPenney, over the past couple of weeks here, I've had a number of inquiries about JCPenney. Maybe the stocks will buy here. They're under reorg, which means they filed for bankruptcy, but they filed for reorganization bankruptcy, which means basically that they're not going out of business. They're trying to basically restructure their debt. They're closing some stores. So I've had a number of inquiries about JCPenney and buying it. So let me explain something here, which we talked about. Just because the stock has got hammered in price, I'm not sure where JCPenney came from, don't follow the stock, don't like the stock. But a lot of people will say, well, the stock was trading at 30 bucks, Professor Milligan, and now the stock's trading at pennies on the dollar, $2. I think this is going to work. So I want to invest and buy JCPenney stock. So here's what you're looking at. Make sure you understand what you're looking at. Put a little color on this, do my best to put some color on this so you can actually see. You're looking at JCPenney, and the blue line is the earnings estimate, and the orange line is actual price. So you can see that going back to 2016, you can see that earnings per share for JCPenney were going down. So it looks like here in 2016, we're up here at $1.50. In 2017 to 2018, we went from $1.50 down to $0. And then from 2018, 2019 to where we're at now, we've had negative earnings. Make sure you understand what that means. Negative earnings means that the corporation is actually spending more money than they're actually generating from revenue. All right. So when you get down to your bottom line, let's put it in perspective for us as people. You're making $100,000 a year and you're spending $120,000 a year. All right. That's what this is showing you. So this company that you're looking at investing into, because the stock has become so cheap. Well, the reason why the stock has become so cheap is because the earnings per share have been going down. Now, if you look down here at the bottom chart, the long-term trend, it's showing you the exact same thing. Now, the blue line is the estimates for 2019 in terms of earnings. The orange line is for 2020, and the red line is for 2021. So what you're seeing here is you're out here investing in a company that's going through a reorg, and I'm calling it speculation because fundamentally there's no reason to buy this stock. There's nothing going on here with this company. All right, that's why they're trying to restructure it. So in other words, you're buying a company that has no proof, no evidence, not showing anything that would actually lead you to believe that this company is going to turn around in the next year, 2 years, 3 years, 5 years. All right. But what you're looking at, again, these are earnings estimates. So we'll talk about PE ratio a little bit more, but right now you're looking at the earnings estimates for JCPenney, and you understand what's going on. And this top chart really says a lot. You can see, I keep telling you, when it comes to investing in growth stocks, one of the things we always look at is earnings, earnings, earnings. And you can see that as the earnings went down, you can see the price correlation between earnings and the actual price of the stock. You can see what's going on. You can see that the stock is just going down. All right, let's move on to something else. All right, what I did now was I pulled up the earnings, actual earnings and earnings estimates for Visa. Now, the reason why I bring this up is Visa's not having the same problems as JCPenney's. So what you're looking at on the top chart here is you're looking at the orange is actual earnings and the blue is the estimates. So you can see in 2018, they met estimates. 2019, they met estimates. Here are your estimates for 2020, 2021, and 2022. Now, to give you an idea of the earnings history, this chart right below the middle chart shows Visa's earnings estimates for 2020 and Visa's price. So what you're looking at is the blue line is the earnings estimate. You can see what's happening with earnings. They've been increasing. They increased, and again, they increased. So we've seen steady growth in earnings. And notice that the stock price is going right along with those earnings. Now, again, here in 2020, coronavirus, possible recession, depression, so forth. You guys know what's going on. You can see that the earnings have dropped off. Not unexpected, but look at the price of the stock. Highly correlated to the earnings. Again, when it comes to buying growth stocks, it's earnings, earnings, earnings. And then again, down here on the bottom one, and I got these from Y chart, so feel free to get it from Y chart. But again, you can see here, the blue line is 2018 earnings. The orange line is 2019's earnings, and the red line is 2020 earnings. All right, so you can see the difference between the stock price and earnings from Visa as compared to JCPenney. Now, what I'm showing you on this chart, again, this is Chipotle, and I'm showing you the price earnings ratio. The price earnings ratio. So let me do a little writing here. Make sure you understand what's going on here. The PE ratio. So what do we do with that? Well, right now, let's use some examples. Let's say I have a stock that's trading at a multiple PE ratio of 20 times earnings. All right. And again, with a 20 multiple, it means that I expect growth to be around 20%, somewhere in that range. So we have a 20 PE multiple, and let's say that this stock is going to earn, we expect our future earnings per share to be $2 a share. Well, if we take 20 multiple times $2 a share, means we should have a $40 stock price. So again, PE ratio, we take the PE ratio, we times it by our forward earnings estimate. So in other words, what I'm saying is we're forecasting that this company is going to earn $2 a share in earnings for the year of 2020. I'm going to take that multiple of 20 times it by the $2. I got a $40 stock. Let's say that that multiple, which you're seeing in front of you on this chart, that multiple expands to 22 times earnings. And let's say that in 2021, they're expecting not to earn $2 a share, but to earn let's do a growth of 20%. So $2.40 a share, $2.40 a share. So we know that, again, the PE multiple is expanded, good market, company's doing well, and the earnings are growing at a 20% annual growth rate. So based upon this, now we're looking at a $52.80 stock price. This is how we use PE multiples. This is the early, simple version of what Wall Street does to try and determine price of stock. Why am I showing this on Chipotle? Now, this is where it gets really interesting. You can see at one point, Chipotle's PE multiple got as high as 450 times earnings. Right now, it's trading at 86 times earnings. So a couple things. PE ratio is the multiple that's used to figure out stock price. So they're saying that for every dollar in earnings, you're willing to pay $86 for that stock. PE ratios typically are highly correlated to the growth rate in the company. A 30 multiple, a 35 multiple is about the highest we'll go. When we get up here in the 86, there's not a company that can maintain an 86% growth in earnings. It's just mathematically very difficult to do. especially for a company that's been around as long as Chipotle is and the size of Chipotle. Now we're looking at United Airlines. And again, you can see United right now is currently trading at 10 times earnings. You can see, looking at the multiple, it's gone as low as, it looks like, about 2 times earnings and been as high as about 13 times earnings. So you can see this multiple here contracted. So the PE multiple contracted from basically, looks like, about the $8 multiple down to below 4. Then it rebounded here. And it looks like that historically that company's trading between an 8 multiple and about a 12, 13 multiple. And then right here, again, coronavirus hits and that multiple drops down to about 3. We can see the multiple expand, shoot back up, and now it's trading at 10 times earnings. So again, what they're saying to you is they're willing to pay $10 for every dollar in earnings for the company. You want to know what you think the stock's going to be worth a year from now? Let's say that a year from now, you estimate that the stock is going to earn $2 in earnings. Well, 2 times 10, you're looking at a $20 stock price. PE multiple, PE ratios, this is what we're doing. This is a short lesson on valuation. Next stock, Hertz. Been getting a lot of calls on Hertz. Once again, look at this multiple. Hertz was trading at 180, 190, 120 times earnings. The reason why Hertz was trading at such a high multiple is because Hertz had no earnings. And as the earnings went negative or went down, and the price of the stock held steady or went up, this multiple got out of whack. This was a company in trouble, and you can see what happened here. Basically, what you're looking at here from 2017 to 2018, they probably had no earnings, so there was no PE multiple. You don't do it with negative earnings. And you can see right now it's trading at 2.3 times earnings. So let's round it up to 2.5. It's trading at 2.5 times earnings. Hertz is going through a reorg. Hertz is not in a reorganization, bankruptcy. They're looking to restructure their debt. Investors want to buy their stock. Their stock could end up being worthless. So that's what you're looking at here. And with this multiple that you're looking at, again, if the stock earns $1 in earnings, you're looking at a $2.38 stock. So again, this is not a growth stock. If you're trading or buying Hertz, you're in pure speculation. There's no fundamental reason why the stock should go higher or move from here. So you're speculating that they can turn the problem around and solve it. And if they don't solve it, your stock is worthless. This is pure speculation. Look at Visa. Again, between 24 and 48 multiple, but you can see over the last year, 2 years, it's basically trading between a range, it looks like, of about high 20s to high 30 multiple. And right now it's trading at 34 times earnings. So again, you're looking at earnings ratio. You're looking at, over here, investors were willing to pay more. So this is a typical range. Apple, another interesting story. Again, look, 2016, the economy started to correct. We did not go into recession, but we really slowed down. So there it is right here. You can see what happens here. Again, trading between 15 and 20 times earnings. Then, as you guys know, Apple took off, started doing extremely well, pushed the market, and you can see it's trading as high as 25, 26 times earnings right now. So that's where we're at. And again, the multiples expanded, and the reason why the multiples expanded is because the growth's expanding, company's doing better. So that's why you saw an expansion in the multiple. Income statement. The reason why I put up an income statement was we discussed companies that can go into bankruptcy because they cannot service their debt. We talked about the times interest earned ratio. So I'm actually going to show you now how to actually do a quick glance and see those ratios. I'll discuss a little bit up the income statement, but you'll get the general point. So what you're looking at here is you're looking at the income statements for Hertz. I've had a lot of questions about Hertz, so I figured I'd grab something that you guys were asking me about. So here's your revenue for Hertz for 2016, 17, 18. Revenue, total sales, how much they sold and how much money they made. Just a quick note, Hertz was not a high growth company. You can see here looking at the revenue that there was no growth in revenue from 2016 to 2017, and then 2018, 2019. So you're looking at an average annual growth rate for the last 4 years of Hertz of 3.99%. So again, there's our revenue. Underneath that, you'll see what it costs to produce that revenue. Those are expenses. There's our gross profit. Then from our gross profit, we take out our operating expenses, advertising, selling, healthcare, rent, mortgages, so forth and so on. Then from here, we subtract out depreciation. And after everything's subtracted out, we have our operating income right here. So let me circle operating income because this is key. Operating income. And right underneath this is our interest income or expense. Everything from here to here, operating income, is from running the business. This is known as your operating leverage. Everything underneath this is known as your financing leverage, how we finance the growth of the company. And you can see right here, the first stakeholder that we're talking about, interest expense, belongs to the bondholders. This is the interest paid annually to bondholders. Our times interest earned ratio is equal to our operating income divided by our interest expense. This is our times interest earned ratio. So let's highlight that in red so you can see this right here. So without even doing any math, let's make sure you understand. Here's how much income you have. It's how much income you had from running your business in 2016, or I should say Hertz. And this is how much interest expense they owed, $545 on the $75. Now these are in millions. So you can see they're not generating enough to service their debt. They're not generating enough to service their debt. They're not generating enough to service their debt. In this case, they generated just enough to service their debt. So what you're looking at is this. Here's a corporation that for the last several years has not generated enough operating income to pay the interest expense off their debt. That is the straight definition of bankruptcy. Okay? That's what you're looking at. So as we go further, and I always ask you guys, if that's the case, if they're not generating enough income to satisfy their interest expense, what makes you think things are going to change going forward? That's why I say Hertz is a speculative investment. Fundamentally, nothing's changed for the company other than the fact that they're trying to change how the company's run and how they're going to service their debt. And that's why they declared bankruptcy. The reason why I call it speculation, there's no reason other than you thinking and hoping that they can fix things, that this stock's going to turn around. You might see a dead cat bounce. It might move up and down a little bit. But again, some major problems here. So again, you're looking at the same thing. This is Hertz. The reason why I came down here is, since we talked about this earlier, I want to come down here to show you why else I put this up. All the way down here, net income. So after they satisfy bondholders, after they satisfy the IRS, if they had any preferred stockholders, which they don't satisfy them, net income is what belongs to the common stockholder. This is paid out in terms of dividends and or goes into retained earnings. Now, here's why I bring this up again. 2016, they lost 491. They made money in 2017. They lost money in 2018. They lost money again in 2019. If they're not generating enough money to grow the business, where's the money coming from? Well, one is they're pulling it out of the coffers, which is retained earnings. And two, that's another reason why you're seeing them trying to issue so much debt and issue common stock, because they need to raise money. Now, one last point, which I want to bring you down to here. If you take the net income and divide it by the number of shares outstanding, what you will get is earnings per share right here. And again, you can see -$5. Then they made $10. They lost $2.10. And then right here, they made 50 cents. So as you can see that they're having problems in terms of earnings that are being made to actually pay common stockholders. And again, reminder, Wall Street values companies. One of the key elements they look at is earnings per share. How much is being earned per share? And again, in this case, you can see that Hertz is not earning much per share. They're losing money per share here. So again, very speculative. For kicks and giggles, laughs, I put up a couple other companies here too. So one of the companies I put up, which you'll see right now, is Visa. So what you're looking at here is Visa's revenue. There's the total revenue. There's your cost of goods sold. But let's work our way down here, and I want to circle these two right here. So now we can actually calculate the times interest earned. And again, the times interest earned is nothing more than interest expense, which is $533. So we'll take the operating income, the $15,001, divide that by the 533, and we'll get our times interest earned ratio, 28. It means for every dollar in interest expense, they're generating $28 in operating income to service that debt. This is the reason why Visa has no problems. That's the reason why Visa will not see bankruptcy. They have more than enough capital to service the debt that they have. That's what we're looking at. If I'm looking at a company, if we go into a recession / depression, I think the market's headed down, the company's about to collapse, Visa is not, repeat, not one of the companies I would short based upon cash flow. They generate more than enough cash flow to service their debt. Again, sticking with Visa, when to come down here on Visa real quick and show you again. Here it is. There's your net income. So I wanted to come down here real quick on Visa and show you. Here's Visa's net income right here. And we come all the way down here to the bottom line. And here's Visa's earnings per share. Just so you know, Visa, for the last 2 years, for the last 4 years, Visa's earnings have been growing at a compounded annual growth rate, a CAGR, of a little over 31%. So again, you can see why Visa stock has been doing what it's doing as compared to Hertz stock. They're making money, they can service their debt, and which is what I told you, Wall Street values companies based on earnings per share. And you can see that Visa's earnings per share growing at 31%, stock prices following the earnings, the growth of the company. Now we're looking at JCPenney. So again, income statement, there's your total revenue, working our way down. Now here's what's interesting about, circle this again. We're working on times interest earned. It's not like I'm not ignoring these other items. I just want to make sure you understand we're looking at companies that are in the risk of declaring bankruptcy because they cannot service their debt. So again, you can see it right down here. We can see it. It's all in color for us. In 2017, you can see the interest expense was $363, which was greater than operating income. The same thing in 2018, same thing. In fact, in 2019 and 2020, JCPenney had negative operating income and had interest expense. So you can see that again, this is the reason why they're declaring bankruptcy. This is the reason why they're restructuring. They do not generate enough operating income. The business is not generating enough income after they pay all their bills and expenses to service bondholders. And that's the reason why they're looking at bankruptcy and filing. And remember, of all the investors between bondholders, preferred stockholders, and common stockholders, bondholders get paid first. If there's nothing to pay bondholders, there's nothing left for the preferred stockholders or common stockholders. Right, that's what we're looking at here. And right here are your earnings per share. And again, a loss of 6 cents, a loss of 62 cents, a loss of 81 cents, a loss of 84 cents. So again, common sense, guys. I know you have it. If you were running a business, or if you're looking at a business, or if somebody came to you and said, this is my business, I'm losing money and I've been losing money, the first thing you'd say to them is, why are you still in that business? All right, so I mean, it's just obvious. So let's clear that up. You got that. So again, you can see it right here. We're looking at Apple, and here's what you're looking at: operating income and interest expense. So again, on this one, we'll actually do the calculation. We've got $63,930. And again, this is in millions. You have that in terms of operating income. You have interest expense of $1,385, which gives us a time interest ratio of 46. So for every dollar in interest expense they have to pay, they generate $46 in operating income. So here we are looking at the bottom of the income statement for Apple. This is our financing leverage for Apple. You can see that net income is positive. So there's your net income. And again, this is in millions. So net income is positive. You come down here and you look at earnings per share. You can see that your earnings per share also have worked extremely positive as well. Apple's earnings, historical earnings, have a compound annual growth rate of a little over 14%. The Commitment of Trade Report, C.O.T. This report comes out on Friday, but it covers from Tuesday of the previous week to Tuesday of the current week. They collect all that data, so it's a weekly data, but again, it covers from Tuesday of the previous week to Tuesday of this week. They break it down into 3 basic categories. The first category are small investors, you and me, mom and pop. We're buying 1 contract, 10 contracts. In fact, whether you're trading 10 contracts or 10,000 contracts, you're still considered a small investor. The other group that they keep data on, they break it into 3 groups. The other group is the large speculator. These are the funds, the hedge funds, the commodity funds, the CTAs. These are all institutions that trade these securities, but again, they're speculators. So they're basically speculating in terms of price, volume. They're making money on these by trying to. The third group is the commercials. The commercials are the companies, the corporations, the farmers that either will make delivery of the underlying commodity or take delivery of the underlying commodity. So example, Starbucks is a commercial. Starbucks takes delivery of coffee beans. Starbucks takes delivery of milk. So they're in the futures market and they're trading coffee beans, coffee, and they're also trading milk. A farmer is a commercial. So a farmer that's growing corn, a farmer that's growing soybean, a farmer that's growing wheat, rice, they're also commercials. They're either going to make delivery of the corn, or they actually might take delivery of corn and buy corn to actually redistribute. So these are the 3 basic groups. What you're looking at now is a price chart of corn. All right, the commodity corn. This is the corn futures. Let's see, we're going back 4 years. This goes back 4 years, and it's weekly. This line, purple line, is open interest, and this is volume. Down here is a commitment of trade report, actually graphed out to be used as charts. The red line, again, is the large speculator. The green line that you see here is the commercials. What I always tell people, which I'm telling you guys, commercials dictate future direction. The large speculators are the ones that drive. The commercials give direction. The large speculator drives the market. So let me go to the next slide. I think you get a better understanding here. What I did here was I took the large speculators and I overlaid them on the corn chart. And what you'll see is typically how large speculators work. As the market goes, they're going right with it. Corn prices drop, they're going right with it. So a large speculator, if they think prices are dropping or prices are going to drop, they're going to close out their long position and literally go short. When they think the price is going to go up or starts to go up, they close out their short position and they start building a long position. This is the way that they make their money. They're momentum traders. Last in, first out. That's why I said they drive this market. If corn prices are dropping, large speculators are selling that market and getting short and pushing it down. When you see this market going up, it's because the large speculators are pushing it up by their buying. The next slide, these are the commercials. I want you to see this, and I have more of these for you to study, but when you look at this, realize this. When corn prices spiked right here, you'll also notice that the commercials got net short. In other words, as a group, they were playing for the price of corn to come down, not go up. And that's why you see them selling it here and they were net short. And as you see, prices fell. Now look what happens when the commercials are net long. The net long here, the net long here, the net long here. What I mean by net long is that they have more positions to the long side, to the short side. So as an aggregate group, they're net long. And as you can see by the amount that they're net long a larger amount here and here. These are peaks. And look at what happens down here to price. When these peak, prices hit bottom and they start to go up. Right here, at this point, corn futures were net long at a high level and corn prices took off. In my call this past week, I talked about how I said that based on fundamentals, I was bullish corn. Here's why, right here. But as this price stays down here, the commercials that deal in corn, the farmer, Archer Daniels Midland, that makes high fructose corn syrup, the commercials that buy and sell corn, they're net long, which means they think the price is really cheap and it's cheaper for them to buy corn in the futures market than buy corn from the farmer. So they went net long corn because they believe that from here, corn prices are going to go up. This is what I look at. Let's look at some other ones. So this is corn. I hope you understand, and I'll talk about it. What we're looking at now is treasury bonds. This is a 30-year treasury. Here's your 20-week moving average, but don't worry about that. That's the price. Again, I went 4 years. There's open interest, there's volume, and what you're looking at down here is your commitment to trade report. So let's go to the next slide. So once again, these are the large speculators. You can see the correlation between the actual price and the speculators. They're going hand in hand together. The next slide is our indicator. Here's what you're looking at. You can see it here again. Commercials, the people that have to actually make or take delivery of these treasuries are net long. And look what's happened to the price. Then when they get net short here, and they get to the short side, you can see that the price starts to drop. Again, here they got net long. Here's the move to the upside. You can see it continues to the upside. Here's a little down, and you can see here's the separation. The thing I need you to understand is we can't tell how big a move's going to be when they're net long, whether this is just going to be a small little blip or a major run like we have here. Fundamentally, that's what this is. I have no read on treasuries right now. It looks like they're trying to get net long. One of the things that I do is I don't try and speculate in between the highs and lows. I look for extreme points. Let me go back to corn. See, this is an extreme point right here. This is extreme. Here, let's look at it on this chart. You can see it's extreme. And as it goes, the commercials are long net corn, the largest position they've had in the past several years. They're buying all they can get of corn. You can see it in the last several years. So again, this is a weekly chart. It's showing you what's going on with corn. And then here's orange juice. There's a regular chart that I look at. Here is the open interest. Here's volume. Here's a commitment to trade report. And then as you see, I lay it over, which we talked about. So what I did here was I overlaid the large speculators. As you can see, the correlation, high correlation between the price, large speculators. On the next slide, you're looking at the commercials. And again, you can see it. Commercials, net short in here, price is dropping. Here, the net long. You can see from here, we kind of bottomed out and it started to go north. Again, here is right here. Now, this is what I was talking about when I say about extremes. If you look right here, which is right here on this chart, right here, we're not an extreme. I look for these extremes to give me reads. So once we got up in here, in this read right here, is when I said, okay, I'm turning bullish orange juice. Now we're looking at a weekly chart. You can see here, it looks like it took 3-4 weeks, maybe longer, to bottom out, go sideways, and then turn and go back up. This is the reason why when I talk about trading these, I've had some future positions that lasted 6 months. The return was 10-1, which means I made 10 times my investment. But again, it took 6 months because I was trying to find a longer term trend. And again, here, you can see net wise, we bottomed out here, which means that they're playing for the price to go down. You can see there's a little blip down here, another run here. But then again, a month later, took some time. This is the leading indicator. I keep telling you that. A couple of weeks later, you can see that when it finally turned and went, you can see the whole move down. And when you're talking about orange juice, this is not a small move from this level, which looks like about the 175 level, to about the 100 level, is probably on a investment, probably a 10 multiple on your money. That's why I use this. One is I like the volatility. Two is I get these reads and I build myself a longer term position. I try and buy as much time as I can when I trade the derivatives market. I want to again thank you guys for following me on Instagram and my live channel here, Professor Milligan, on my YouTube channel. So I want to thank you again. You can always see me live every Wednesday. I'll be live on Instagram at 1 p.m. Pacific Standard Time, which is 4 p.m. Eastern Standard Time. So basically every Wednesday, as soon as the market closes, I go live. So hopefully I'll see you there. And then as you guys know, which you're watching now, I'll take that recording and several days later, I'll add to it and I'll put it on my YouTube channel, which is Professor Milligan. So feel free to follow me. And once again, I want to thank you for your support. And as I always say, make money.